Today, we are going to discuss financial leverage and its impact on the value of the firm. This topic will make you understand the difference between business and financial risk. We are also going to discuss the different kind of leverages operating, financial and combined, and how these leverages can be used to overcome the financial risk and increase the firm's value. Through this topic, the student would be able to understand the different kind of risk and how this uncertainty in risk and return can be managed by using these kind of financial tools. As we all know that financial decision is one of the integral and important part of financial management in any kind of business concern. A sound financial decision must consider the broad coverage of the financial mix, the total amount of capital, and cost of capital. The term leverage refer to an increased means of accomplishing some purpose. Leverage is used to lifting heavy objects which may or may not otherwise possible. In the financial point of view, leverage refer to furnish the ability to use fixed cost assets or funds to increase the return to its shareholders. Before understanding the concept of leverage, you must be well aware about the two type of risk a business is exposed to. First is business risk and the second is financial risk. Now, as we all know that business risk arises due to operations and it is measured by variability of earning before interest and taxes. Financial risk arises due to the use of fixed income securities such as debt in the business. So we can say that if the firm capital is total of equity, then it has no financial risk. But in practice, a firm used to have or get exposed to both kind of risk, business and financial. So the major determinant of business risk are demand, sales price, variability. Business risk not only varies from industry to industry, but it can also vary among the industry's firm. Business risk of a firm, it keeps on changing time to time. Financial risk arises when a firm uses fixed income security. So we can say that if a firm is using debt financing or high level of debt financing, then it get exposed to high level of financial risk. Suppose firm A is an all equity firm, then we can say that it is exposed to business risk but not financial risk. So here we are going to calculate only one kind of leverage, that is operational, not financial leverage. Now we have another example, firm B. It has financed 50% debt and 50% equity. So it has both operating and financial leverage. Business risk is largely dependent on the operating cost, technology, market condition, etc. It has little role of management decision. But financial risk is all about management decision and how they are going to manage their capital structure with a perfect blend of equity and debt so that they can minimize operating and financial risk.